Hey, I'm Abe, and today we're going to talk about time horizons like we talked about on Friday when we were originally talking about risk assessment, risk tolerance, and overall risk aversion in your personal investment strategy. A time horizon, or an investment time horizon, to be specific, can apply to a few different things. Now, traditionally, and first and foremost, it's basically the period of time you plan to hold your investment. So if I'm going to invest in Apple for the next 2 years, my time horizon is 2 years. Essentially, for the most part, you don't pick something to invest in forever. It shouldn't be a binary of should I invest in this thing or not. There should be a lot more that goes into it than just yes or no. It should be for how long. And that's where the time horizon comes in. Some of these time horizons are driven by when you want or need that money back. So if you're going to invest in Apple, like we said, for 2 years, maybe at the end of that 2 years, you're going to be selling that Apple stock, you're going to come back and you're going to buy a car. Or at the end of 5 years of investment, you are going to sell that investment and use that as a down payment towards a house. Or maybe a longer term time horizon is for saving for retirement, for example. To be more diligent though, you should think about time horizons and selling your investments, not just because you have to get that money back, and you often will, but also because that's what your plan is. That's what your research tells you to do. So having a time horizon, in addition to understanding and investing according to your risk tolerance, helps you keep a level head when facing market volatility. So if you've bought a stock, I wouldn't recommend buying stocks, but let's say you buy an investment of some kind and your time horizon is 2 years, and in that 2 years, the market is all over the place. Say, hypothetically, there's an expired tub of mayonnaise who's making decisions that impact the economy, and you now are then subject to the highs and lows as people freak out and then calm down and then freak out and then calm down again. But you have made a choice, and generally speaking, you should make that a part of your plan, see that, and then ride out that volatility. And having a time horizon allows you to do that, and so does, like we talked about, having a good grip on your own risk tolerance. So I've chosen this investment. I've done some research. I think 2 years I think over the next 2 years, they are going to do well, whether they is the mutual fund or the exchange traded fund or the company or whatever it is that you're investing in, that you think for the next 2 years, they're going to do well. That's what your research tells you. And so you set that time horizon. And then you should, as with any investment, sort of regularly follow up on it. I don't think you ought to check on it daily and then just be like, obsessing over the thing. But check up on it regularly. Make sure that it's performing in the way that you thought it would. And make sure that your time horizon still makes sense. And there's nothing wrong with having a time horizon of 2 years. And then maybe you don't want to buy that car anymore. Maybe you didn't need to replace your roof after all. And now your time horizon has extended by a year or 2 years or 5 years. And then as you check in on a regular basis, decide whether what course you're on makes sense. Is the time horizon that you originally set still a good one? Is the investment that you chose for that time horizon still a good one? Maybe after the first year you've invested in Apple and Apple's taken a dive and you're really not happy with your investment. You still need to get your money out in another year, and you want to be a little bit more conservative. So you want to make sure you still gain a little bit, but you don't want to put yourself in a position where you could lose a bunch. So maybe you invest in bonds for that last year, just for the security of it. So these are the ways that you can use and think about time horizons. It is a tool in your toolkit to not just plan what you're about to buy. I want to buy this for the next 2 years, but also to think about and research that next purchase. So let's say we think that the next 2 years are going to be good for Apple, but we kind of have an idea of what the next 2 years are going to look like. And we think that the next 2 years is similar to, for ease of conversation, the last 2 years. So if I look at how Apple did the last 2 years, and I think that the market and the way Apple is holding up in that market is going to continue, then maybe my time horizon looking forward is also one that I can use looking backwards. And I can take historical data, which we have, to try to predict the future data, which we don't have and we don't know. This is part of the research that you will be doing and part of the way that you should be thinking about it. Time horizons are very important. Now, they're not locked in stone, like we said. And even if you have a longer time horizon, like you're planning for retirement, that doesn't mean that you pick an investment and then for the next 30 years, you don't look at it, you don't think about it, and you're done, right? That's not how it works. That you can have time horizons within time horizons. You can have a Russian nesting doll of planning and time horizons, because essentially, as you look forward to the next 30 years, yes, you're going to be pulling a large portion of your money out each year in retirement. That doesn't mean that the next 2 to 5 years is a good segment that you should plan for and look at. And then the next 2 to 5 years after that, you may want to readjust your portfolio. Maybe you'll have a 10-year window. Maybe you'll have a 1-year window. Maybe you want to buy a house somewhere in there, right? So that all the while you're still progressing towards that final time horizon for retirement that you set up, and you're still saving accordingly and investing to build towards that goal. But to do that, you need to break it into smaller chunks. And then within those smaller chunks, maybe you still need to break it down further. That if you think the next 3 months is going to be really good for whatever, maybe 3 months is your time horizon for this particular investment, because whatever research you did, whatever you think you know, I would advise, and I generally do, I would recommend that you not invest into individual stocks. It's extremely risky, regardless of your risk tolerance. You are perhaps not a professional stockbroker or investor. This is not what you do on a day-to-day basis. You don't have a PhD in all of this. And even PhDs and professionals can't reliably predict the future. They can make a lot of good bets, and just by statistics, they're able to, using their expertise, build something that makes a little bit more than everybody else. But nobody has a crystal ball. Nobody can see the future. And you need to be careful to set yourself up for success when you invest. And the ways that you do that are the ways that we've been talking about. You understand your risk aversion, you understand your time horizons, you understand your goals, and how you go about doing that. You want to diversify, and so on and so forth. So today we're talking about time horizon. Tomorrow we'll be talking about some other way of thinking about it. Hopefully we'll have our collaboration with GZC or Gen Z Credit going soon, maybe later this week, maybe the following week, I'm not sure. But until then, hit me up with what questions you have. I hate to say it, in response to some of a comment that I got from Aldo, I'm sorry, but I'm not comfortable giving individual stock picks or individual investment recommendations. I'm not qualified. I'm not a professional investor or broker. And even if I were, we would have to have a business relationship in order for those sorts of recommendations. So I am not equipped to do it, and you should not be taking investment advice from me for specific things. Like, I'm not going to sit here and tell you, invest in Ford. That's just not the sort of thing that I'm going to do. And I'm not comfortable doing that anyway. So thank you for asking, but I'm trying to, and I would like to give you the tools so that you can go out into whatever area that you want to invest in, and then take an intelligent look, take a methodical look, plan out what you want to do, assess whether you think this is a good investment, make that move, and then be able to continue to assess it as time goes on. So let me know with what questions you have. Hit them in the comments below. I'll put some other resources down in the video description. Thanks for being here, and I will catch you in the next video.